2019, so far so good. We've been off to a good start. The concerns which haunted us post Christmas Eve, both at a global level and at a local level, looks like they're getting addressed. For the moment, the fear of trade war, it's on the back seat. For the moment, volatility in crude and the currency seems to be subsiding, and flows, which are often the most important relevant factor to gauge the short term and the medium term market direction, they are looking stable. But after the twists and turns of 2018, are we in for a stable 2019? The script of how Indian markets moved in 2018 was a function of macros and only macros. Will classic, old-fashioned stock picking make a comeback? Let's discuss that on today's edition of Market Maker with one classic stock picker who believes in his principles, his solid foundation of understanding markets and his assessment of various sectors and companies. Ravi Dharamshi, ValueQuest is back. Ravi, fantastic to have you back.
Thanks, Nikunj. Thanks.
So it's not time out to wish Happy New Year.
Happy New Year to you as well. Yeah, I mean, we are just happy that 2018 is over.
Well begun is half done?
Yeah.
Or this is just the beginner's luck?
No, I think first of all, our tribute to John Bogle. I think there's a lot of contribution to the fund management industry, and one has to recognize that. Coming back to 2019, I think we really went through a rough period in 2018, especially if you are somebody managing a mid-cap concentrated strategy focused on Indian mid-cap, small-cap. So valuations are now in your favor, and some of the things that were really bothering like the crude or the interest rates going higher, I think those things have now fallen in place. We can be a little more sanguine about the prospects of interest rates hardening as well as the crude going up. So I think that bodes well for the Indian mid caps, and relatively they are way better valued today, as in way more reasonable. So I think 2019 will definitely augur well, much better than 2018.
In 2018, especially in the late leg of 2018, we saw global scare, and it was a scary sell-off in Dow, a huge meltdown in some of the so-called halo stocks, the FANG stocks. So far, we managed to survive the first hit, the first storm. But if this is a recurring unwinding or long unwinding, emerging markets like India will also get hit hard.
Right, sir, it's surprising, definitely. But I would say 2019 is going to be more a year of mean reversion than anything else. I think there was a huge, since 2009 bottom, American markets have had a huge outperformance to the world market. I mean, global market cap moved from $25 trillion to $85 trillion over a span of a decade. And the biggest contributor to that was the US market. Emerging market actually relatively underperformed significantly, and this gap between developed market to emerging markets had reached a really wide point sometime last year, and that I think is reversing. So that is one of the reasons why we did not see a sell-off, even though nearly $1 trillion were wiped off just from the FANG stocks in US. So I think because FIIs have been sellers in our market since last 2 years. It's not a phenomenon of last 3 months, 6 months or something like that. So we have constantly been going down in weightage. Our market cap probably peaked at around 2.5 trillion and came down to 1.8 trillion. So we have also seen quite a bit of wealth erosion, and that is why today I am much less worried about a global crisis setting off or some kind of a contagion which can make our markets collapse. I don't think we are facing that kind of a scenario today.
Okay, in markets we have to look forward, but I'll look back, and not look back for last 1 year, but last 2 years. 2017, the big year for fund managers, the big year for small cap investors. 80% of the market went higher. 2018, 18% of the market either went lower or it remained stable. What is in store for 2019?
You said it right there. In 2018, one of the studies that we did, more than 50% of the stocks fell more than 50%. In that kind of a scenario, I don't think your portfolio can be too much different than that. But enter 2019, there are many opportunities available for you to invest, and those risks where there were unreasonable valuations or unreasonable expectations, those have been taken out of the market. And now there are good set of companies available where there can be significant returns made over the next 2-3 year period. It might not be immediately in 2019 because some of the concerns are real. It's not like without a reason that these stocks have come off. There are good reasons. So, but that is where the opportunity lies. But opportunity is dressed in overalls and looks like hard work.
Are you able to find enough businesses which can give a potential earnings growth of 20 to 25% for next 2 or 3 years? And are those businesses available reasonably now?
Yeah. So let me the kind of buckets that we have. Is there an opportunity in the market today? There is an opportunity. What are the kind of opportunities available? So what we look for is a good business, good valuation, reasonable valuation, and a business tailwind. Now, it is very difficult to find a combination of all these three things present. So that definitely is very, very minuscule. But at the same time, if you were to take in, let's say there's a little bit of a cyclical headwind in the business, or there are some with structural headwind also, then if you are willing to look at those companies, then there's a bucket of and a pool of companies available where you can, if you stretch your horizon into 3 and 5 years of investment, then you can make good money over there. But you will have to live through next 12 months where the problems are still, it's still in the transition phase of turning around. For example, I mean, if I just to put some context to it, so PSU banks or real estate developers, they are going through some real tough times. Those are structural issues. But valuations are not an issue over there. It's only an issue of whether and if the sentiment will revive, the business tailwinds will come back. There is going to be a big supply crunch for sure. The number of players are going to be whittled down dramatically in real estate. So that's the positive.
So are you happy to buy a real estate stock? Do you own a real estate stock?
No, I don't own any. And only the thing I'm saying is that's a bucket which requires more than 5 years horizon. Then if you look at something that has more cyclical business headwind, then I think over there your horizon can be 3 to 5 years and you can still make good kind of money. And managing public funds, it is sometimes we face challenges having a 10-year kind of a horizon. So we have to look at 3 to 5 years. So over there I would be more willing to buy a company which has some cyclical headwind going on and which can be corrected by, let's say, the raw material prices coming down, or let's say some amount of stimulus being given to the economy can lead to a spurt in growth. Those kind of situations are much more is more clear and present opportunity for us today.
Okay. So if we talk about your portfolio positioning, Jan 2018 versus Jan 2019, how many stocks have vanished? How many stocks have entered? And in terms of an aggregate approach, is there anything new and different, or it is extension of same?
No, I think, I don't know if you remember, but we spoke about it last time. So there are stocks which are priced to perfection, and especially though some of them are on the consumption side. So we are out of stocks that were priced to perfection. They are fantastic companies, business tailwind, everything is going in favor. But there is no room for error.
High quality,
high quality, high performance, highly valued. Yeah. So the money has been chasing with very, very few ideas in this market, and those few ideas, because the ideas are few, have been really, really outpriced now. Now, as long as the business tailwind continues, the valuations can sustain. But I think there is a real risk over there of a significant underperformance with a 3-year point of view.
You've seen that in iShares. We started seeing that in a page. I think you're referring to pretty much the same obvious.
Yes, examples. That is the pool of companies that I'm referring to. No one particular name, but yeah, that is the kind of thing. I mean, whether it is Page or iShares, or even for that matter, Britannia or
Ramdev Agrawal told me one thing, which is that महंगा रोए एक बार सस्ता रोए बार बार. We are always trying to find something very cheap, but it doesn't work.
No, it's not like we are looking for absolutely, we are not going down the junk road, but we are at the same time, Infosys can have 10 years of underperformance, Hindustan Unilever can have 10 years of underperformance. So you better be clear about what you are buying, and I think the risks are real in terms of underperformance over the next 3 to 5 years kind of a view. You cannot, any long-term investors horizon also, that is a risk.
Okay. So you've been bullish on private banks, you've been bullish on select chemical names, and you've been bullish on select retail stock fashion names. Have those themes extended themselves for 2019?
Yeah, so, private banks definitely, the theme continues, but probably now some of the larger or the retail banks are not the ones to be focused on. Corporate banks are better placed. I think that is where surprise possibility is there in terms of earnings, as well as the comfort is there in terms of valuation. So larger private corporate banks, or for that matter smaller private regional banks also, they provide a very good risk to reward with a 5-year point of view. If the capex cycle, the corporate cycle was to revive, and I think that should revive, whether it is in the next 6 months or next 18 months is the only question. And that is definitely a fertile area to look at.
You don't think corporate banks is becoming like a consensus trade? Or maybe I'm speaking to all the smart guys who are bullish on corporate banks. So I don't know what is this a coincidence, or is this a consensus trade now?
No, so consensus or not, you have to look at the price performance, and you have to look at how much of the ownership is with the institutions. And if you believe that the price performance has been fantastic, then I think the performance hasn't even started yet. Honestly speaking, they are still available. These banks are doing sub 1% ROA. I think over the next 3 to 4 years, the ROAs will move from 0.7, 0.8 to 1.2, 1.3, and with some bit of leverage, the ROEs can move beyond 15%. In that kind of a scenario, all these banks that are quoting between 1 and 2 can quote anywhere between 2 and 3. So I think, I mean, we are at the beginning of the story. We shouldn't be worried about consensus at this point of time. It's a large pool. FIIs have been selling, and I don't see us being in an overcrowded trade by any stretch of imagination.
You own this reputation of being the pharma expert on the stock market. When it comes to pharma, you know, we look up to you, we look for your thoughts. When you see a experience like Sun Pharma in 2018, it just shakes you. It shakes you that here is the bluest of the blue chip company where corporate governance standards have been raised for a sector and for an industry where debt is not a problem. Growth may be challenging, but they've never had a debt problem. What does that speak for the sector?
So I think this doesn't speak for the sector per se. I think it's a company specific issue. The sector issues were definitely more on the FDA front, and I think those are behind us. The corporate governance issues, I don't think they were completely unknown to the market. It's only that they are out in the public domain today, and they probably didn't matter when you were a small company. Today when you are in trillions of rupees of market cap, they matter a lot more, because all the global FIIs have taken an exposure to your stock. So I think there is no choice but to get your act together, clean up the books, and you are right. So they have a issue of you know, their net debt they don't have, but at the same time the cash in US and the cash in India, the cash in US and the debt in India. So they are not able to.
It's not matching.
Yeah, it's not matching. So they have a unique situation where they will have to probably get out of this mess in some way, but I don't think it reflects on the sector per se. It reflects more on the company.
We started with John Bogle, but
yeah.
Let's go back to our favorite investor, Warren Buffett. We'll
Yeah.
have to quote him, we'll have to talk about
Yeah.
him. I wonder if he has to start charging IPs for
Yeah,
his
he should
quotes.
charge a royalty.
He'll be a richer man by $1 billion
For
every
sure.
year.
For sure.
He pretty much is alluding to what you referred to, that you have to buy good businesses when there is a temporary slowdown or news is bad. Where else do you see this kind of an thesis getting played out?
So one space where 3-4 years of a bad period is coming to an end, I believe, is agri inputs side. Agri has been in a distress, and it's more because of agri prices being down than anything else. The global cycle also was on a slowdown since last 3 years, and I think over here there is a very good possibility that over the next 1 to 2 years there will be a pickup. The local government,
despite what data we are getting from rural India?
No, so because there is so much distress, that is when governments will be forced to take action, and when government take action, it will result. I mean, you want to be positioned for it today.
Because the puck is going to move.
Correct. So because there is distress today, there is no choice but the agri prices to move up over the next 12 to 18 months. And finally, this is a cycle. If a farmer is not getting good realization for its crop, he'll move to another crop that gives him better realization. So that will eventually create shortage in the other crop, and that will make the prices move up. So I think cyclically, from agri prices point of view, we're close to a bottom, and we should move up in the next 12 to 24 months, and that is the local cycle. But even globally also, I think the commentary of the large chemical companies has now started being positive, and they have started witnessing growth, which had come down to close to zero. Now they are talking about 5-7% kind of growth. So that the confluence of local and global cycle picking up together, that should play out in the agri input side, and we prefer agrochemicals over other inputs.
The thesis of cyclical recovery, the thesis of attractive valuations or reasonable valuations is no longer there in consumers or retail banks, or for that matter some of the other obvious names. Some of these opportunities are there in the B2B space, but the challenge with the B2B space is that you will not see a huge P expansion, and you will not see a huge margin expansion. I'm sure you're aware of that.
No, so you're absolutely right. On the consumer front, getting a good business at a reasonable valuation is the biggest challenge. And even though as a thematic we are really bullish on it. On the B2B consumer side, there is a possibility. I mean, I slightly disagree with you over there that PE expansion cannot happen, and markets have done more funnier thing. It's not like it's my base case to bet on a PE rating over there, but I think if an upcycle over there extends beyond what the market can imagine right now, then they move to a higher and higher plane in terms of rating. So consistency in performance is the most important thing, which I don't believe that we have grounds for that as of today, but I will not rule that out.
We spoke about a niche pocket which you like within the finance space, and that was the small finance bank. Now the RBI ruling has just acted as like a sledgehammer for some names there. Are you still bullish on those names with the RBI red line?
Absolutely. I think, they are small in size, 2,000 to 5,000 crore kind of a loan book size and similar kind of market cap. That's number one. Second, we have to realize they are not NBFCs anymore, they are banks. They have gone through the pain of taking over the costs of the banks. They have started providing SLR, CRR, and the costs of converting their branches into a bank branch, going from a second floor to a ground floor. So those costs are in the numbers. MFI still remains a very profitable product. Well, there is a non-MFI SFB also. So I'm not talking only about MFI SFB. And the SME space is the most lucrative space in terms of lending. You need to have your processes right, you need to do your lending right, but they have a platform available from where they can grow 20-25% for a decade. That is the kind of runway available to them. Can these 4-5,000 crore loan book become 25-50,000 crore? I'm sure it can become. There is no reason why it should not. They have a license to do that. The ultimate aim is to become a universal bank. SFB is only a stepping stone. And some of the vetting has done by RBI for us. They have given license only to the 10 most deserving guys. So out of those 10, I'm sure at least 2 or 3 will emerge to become a far larger and much better banks.
You own the 2-3 obvious names there, the ones which have just got license from becoming a microfinance to a small bank. Is that the way to approach it? Buy all 3 for whatever is available?
Yes, we do own a couple of those names.
Okay, that's the best way to buy them, because you don't know eventually which one would be the winner.
No, there is some amount of, I mean, you go through their history, you see which one survived the crisis best, and which one is building their liability franchisee properly, which is the one that is diversifying in their product and in their geography, and you take a call based on that. Still, that doesn't guarantee you success, but at least you know what you're getting into.
What would you say the outsized bet for this year?
Outsized bet for this year? We run a concentrated portfolio, and each and every bet for us is outsized. So I will not say that there is any new stock that we have bet on in a big way, but I think just to coming back to the earlier theme, corporate banks and within that smaller regional banks, there is a real good risk reward available over there.
Autos have corrected, and there is a fear that there is a slowdown, but if economy comes back, rural demand comes back, Bajaj Autos and the Eichers and the Mahindra and Mahindras of the world will make a comeback. The way you invest, can you spot an opportunity there, or this is not the alley where you want to walk?
No, I am not very keen on looking for opportunities immediately. So I believe that the growth, EMI-led growth or leverage-led growth is going to witness a slowdown over the next 6 to 12 months. All this growth was led by the NBFCs, and the NBFCs have tightened their purse strings by choice or maybe not by choice. And because of that, the growth will slow down over there. I would rather go to where the end consumer is buying out of his own pocket instead of taking on loans for that.
The NBFCs have avoided a cannonball, but the cruel fact is that, look, there was an asset liability mismatch. They were lending short, they were borrowing short, and they were lending long. This setup has broken. This entire carnival for the moment has got changed. But that also has created opportunity for good players to gain market share. Are you looking at buying something in the NBFC space there?
Again, no. It is not.
But that's the place you would be hunting right now, right?
No, I think the problems have just started. I don't think.
Even in HFCs?
Maybe not in HFCs. Some of the HFCs, the asset liability mismatch is not such a big issue, because that product is, even though you sell 25-year payment, but those are actually 7-8 year product, and some amount of ALM mismatch is necessary for you to make your ROE over there. I'm not buying any HFC at the moment, but I don't think the extent of problem in HFCs, some of the HFCs will be as big as some of the other NBFCs that are, let's say, doing developer loans or any such thing. I think there's a large, not large, but there's a decently chunky real estate developer portfolio which is coming up, and it will be recognized as an NPA over the next 12 to 24 months. And the conditions are not going to get any easier in terms of funding for the NBFCs. I think I would wait. It's a very situation which is in flux. I would wait to see which are the players that are going to survive, which are the players that are going to get hit. And I'll wait for a year or so before I can say, no, the NBFC crisis is well and truly behind us and we can place our bets over here.
So, closing comments. In 2013, when we met, you said, if I get $1 million right now, I would invest it right away. I can see and smell that kind of an opportunity in the market. If you get $1 million from a client after this interview, do you have the conviction to invest it right away in your set of stocks, or you'll wait?
Investing is not an issue. Managing the expectation is an issue. So if I remove, there is money that is available only, that I will invest only when there is a crisis in the market, or I'll invest only when I get the best combination of opportunity, entrepreneur and valuation. So for that kind of a money, there are very few opportunities in the market. But if you are somebody who has a compulsion to look for opportunities, and if the crisis, there is no crisis, X of crisis, I think the valuations are okay. And what we need is some revival in the growth going forward. If that is the case, then I think a reasonable expectation of return can be met. Let's not get carried away. Can I make 10x return or something like that in 4-5 years? Surely, but probably I would be more comfortable maybe 3 months, 6 months down the line, where more water has flown under the bridge. Okay. But investing and deploying in the equities is not an issue. In fact, we are fully invested. We'll probably go fully invested into the elections, and will not change our strategy just because there's an event and that can have a big impact on the market. We are planning to live through it.
You just preempted my last question, so I don't have to ask you my last question on election. I thought I would have asked that as the last question. World may be starting that as the first, but I think the way you manage money, the election would be just one of the events.
Yeah, I mean, it matters a lot to a speculator, and for an investor who has a longer term horizon, I have to only see whether it is going to provide me an opportunity to enter, or is it going to provide me an opportunity to exit.
Well, Ravi, fantastic interacting with you. Wish you a wonderful 2019 ahead.
Thank you so much.
That's it for the moment on this edition of Market Makers. Thank you for tuning in.